So I can't remember if I mentioned it since I say the same things to a lot of classes, but I do try to record our lectures and examples as we go through and post those to Canvas. So that way, if you want to go back and review something that we covered in class, you'll have that video which shows the screen and what we're doing with my audio. So you'll have that available. I'll post that on Canvas. I usually try to post it the next day. It may be Monday. It depends on when the recording gets finalized. But we are ready to start. So I am going to open up the PowerPoint. Move this. Okay. So we are going to start Chapter 8. Chapter 8 is all about accounts receivables. Well, really not just accounts receivables. We're going to talk about accounts receivables, which we covered in college accounting, and we're also going to cover note receivables. We won't get to that today, but we'll start. So Chapter 8, again, if you remember, what kind of account is accounts receivable? Asset, liability, equity? Asset. Asset. Very good. Oh, yay, I like that. Like, strong answer. So yeah, accounts receivable is an asset account. And even further, it's a current asset, which means that we try to receive it within the current year or current period. Okay, so we're building on what we learned in, college accounting procedures. So we learned accounts receivable. Well, what is accounts receivable? What does that mean? What does that account mean?
Money you're owed.
Money that we're owed. Very good. So our clients or our customers owe us money for goods or services we've provided them, right? So we did something on account, we billed them. That's really all it means, we billed them. So they owe us money. Well, in college accounting procedures, because we were just learning the whole process, we made the assumption that everyone paid, right? Is that the real world? No, not even close, right? Depending on the business and our customers. So we know, it doesn't matter though. I mean, we can't get a magic 8-ball or a crystal ball or something and determine, you know, this customer is going to pay and this customer is not going to pay. Obviously, there's indications, there's factors that kind of show a customer may not pay. And sometimes our customers are businesses. A lot of times our customers are businesses. So, you know, if they're like claim bankruptcy, or, you know, if we know that they have like a low cash reserve, you know, there's some indications, or maybe they've been late on payments. There's some indications that, okay, this customer may not pay me. Okay, we can run credit checks on individuals, things like that. But there's some indications. But overall, we don't really know a person, if who's going to pay, who's not going to pay, who's paying on time, who's paying late. So in this chapter, a lot of our focus is going to be on, well, how do we deal with that? Should we count money as an asset that we're never going to receive? So if we know a client's not going to pay, well, we have that as an asset, right? It's showing on our balance sheet, accounts receivable, money due to us. We're counting it as an asset. Is it an asset if we never receive it? No, right? We shouldn't count that. So this is affecting our financial statements. And we learned in college accounting procedures that our financial statements should be accurate, up to date, timely. You know, we need to be reporting accurate information. So if we're reporting full accounts receivable that we know some of that we're not going to receive, it's really not accurate. So the whole purpose of this is to try to calculate how much do we think we're not going to receive. So in college accounting procedures, we worked in absolutes really, right? All debits and credits, they were all final known numbers. You're going to find out as we go through different accounting courses, a lot of accounting is making estimates. You know, we're estimating. So if you remember from college accounting, chapter 3, we did adjusting entries, which everyone loves so much. As a review, those were end of period. So we would wait till like December 31st, the last, you know, month and the last day, and we would do adjusting entries. We would adjust for any revenues that we had, you know, actually earned but we hadn't received yet. You know, expenses that have been incurred that we hadn't paid yet, things like that. So we're actually going to learn in this chapter how to account for a percentage of our receivables or a percentage of sales. There's different methods to calculate it, but how much we think is not going to be collectible. And we're going to do an adjusting entry at the end of the period to account for that. Okay. So that's kind of where we're going. And then the end of the chapter, we'll deal with notes receivable. Notes receivable are kind of similar to accounts receivable. The main difference is with a note, we charge interest. So now maybe they've had 30 days to pay their bill and they can't afford to pay. So we're going to switch it to a note and charge them interest. So we actually get some money out of them not paying. Okay. We could just actually loan money on a note though too. So there's some other instances. That's kind of where we're going in this chapter. Okay. So again, when we do accounts receivable, we're making a sale on credit and we invoice the customer. We give them an invoice and we give them 30 days, 60 days, maybe 90 days if we're really generous to pay that bill. Okay, no interest, but they just have that. And we did this in like chapter 5, I believe, where we invoice them and they may get like a discount if they pay early. You remember doing all of that, like 3% in 10 days or 2% and all of that. So we're kind of building off of that. So we're charging customers, we're invoicing them, and they're classified, accounts receivable again as a current asset. So we kind of went over that. We went over that. So other receivables that we're really not going to deal with too much. We have interest receivable, which we will deal with when we deal with notes receivable. Taxes receivable, receivables from officers or employees. Those are usually reported separately on the balance sheet. They're all usually current assets as well. We'll deal with interest receivable. The others we really don't deal with. But it's just kind of giving you an idea of other current assets. So getting into the fun part, we have uncollectible accounts. That's what we call them. So when a customer fails to pay, we call that an uncollectible account. Okay. And there is a time, though, when we may give them 30 days and they don't pay. And so after 60 days, we're like, okay, they're not paying. They may turn around and pay. It could be a year later. Sometimes we do still collect on those, and we do try to collect on those. But we're going to deal with when we deem an account uncollectible. And really, that depends on the business. The business makes that decision. Some businesses might make it at 30 days. Some may say, well, let's wait till 120 days. It just depends on the nature of the business, the communication, what they're used to as far as their collectibles. So the business itself is going to make a decision on when they determine that a customer account is uncollectible. So what do? Well, if you've ever had a collections call, you might know. I've been there doing that a long time ago, thankfully. But basically what happens is if you don't pay your bill and say you stop answering their phone calls, right? Because that's step one. It's like, oh, decline. And the customer's not communicating with us and we can't get in contact with them or get their money. So a lot of times they actually sell the debts to a collector. So, there's debt collection agencies that their sole purpose is to collect debt. So we would sell it. So that way we get some money for it. So we sell it for a portion of the debt. So say it's $1,000, maybe we sell it and get like $500. And then that collection agency will still try to collect the full $1,000. But sometimes that's why they make those arrangements with you where they'll be like, well, if you pay $650 today, we'll call it good. And they'll go ahead, and they're making money because they're getting more than what the company paid them for the debt. So that's kind of how those debt collection agencies work. Some companies have their own collections accounts, like I know Cox, for instance, because I've dealt with them. They have their own collections account. So a lot of times they'll call you, directly, and you can make arrangements. And so it depends on the size of the company and what the structure of the company is. So some will sell their debts off after a certain amount of time, and others will keep it in-house. So again, they have their own determining factors. Okay. Other companies just don't accept sales on account. If it's a small company, they just say, okay, well, you can use a credit card because credit card debt, that risk is on the credit card company. So like if you have a Visa through like Capital One, you're using your Capital One card at a store, the store is getting cash for that credit card payment from the credit card company. The credit card company is the one that you have to pay, and they're the ones that are taking on the risk. So it depends on the company. It depends on the size. You know, again, like smaller operations, sole proprietors, those operate differently. We're going to focus in this class, just like we did in college accounting, on publicly traded corporations. So most big corporations, public corporations, do have credit sales. But again, a lot of them are selling to other companies, so the risk is mitigated a little there. Okay. So again, it doesn't matter what we do to limit it. We run credit checks, you know, we give small balances or, you know, credit. It happens to every company, okay, where we have uncollectible accounts. So the account in which we write off our uncollectible receivables is called bad debt expense, okay? So bad debt expense is just an expense account. So it increases on the debit side, just like a typical expense account. And when we write off bad debt, we write it off to bad debt expense. That decreases our profits, right? Revenues minus expenses equal net income. So that expense is, you know, being written off. So now our balance sheet and our income statement are more accurate because we're saying, okay, we don't expect to receive this money. So now it's an expense of running the business that I'm not going to receive some of this, okay? I kind of talked about this, like indications that the account may be uncollectible. The biggest indication is that it's past due, okay? That's pretty common. Another one, again, is that they're not answering phone calls from us anymore, or maybe their line, you know, their number has changed. Whoops. The customer files for bankruptcy, customer closes business, or the company cannot locate the customer. They've moved to Mexico. So, you know, all of those are good indications we're not going to get paid. So there's some hints and, you know, clues. But at this point, we can't do anything to prevent it. We just have to deal with it and move on. Okay. So when we're dealing with uncollectibles, how we need to account for them depends on what type of business we are. So again, we're going to focus on publicly traded corporations, but we're still going to look at what we call the direct write-off method. If we're a private corporation or a sole proprietor or a partnership, then we can use what we call the direct write-off method. Super easy. We just say, oh, Steve's not going to pay. We'll write off his accounts receivable to bad debt, and we move on. Bad debt expense gets debited. His accounts receivable gets credited. Life goes on. Okay. So that's good if we're a small company, we don't have a ton of receivables, and we're not publicly traded. If we're a publicly traded corporation, you know, as you learned in college accounting procedures, we have to follow generally accepted accounting principles, or GAAP. GAAP requires us to use what's called the allowance method, okay? Of course, what that means, as usual with accounting practices, that it's the harder method, right? You know, you must use this one, it's more complicated. But the reason for that is it's GAAP compliant. So with the allowance method, we estimate uncollectible accounts at the end of the year, okay? And we'll talk more about this as we go through. But the biggest thing to remember is the allowance method must be used if we're publicly traded, and it follows GAAP principles. Most specifically, it follows the matching principle. Does anyone remember what the matching principle is?
It's been a while.
I know, right? Well, that was like all the way back to chapter 1. But we talked about it when we did adjusting entries too. So the matching principle is also called the expense recognition principle. Or does that ring a bell then? You're like, oh yeah, I remember hearing about that. I don't remember what it was. So the matching principle says we must match expenses to the revenue that the expenses helped us earn, okay? So the biggest way to look at that is we want to expense off accounts in the year in which those sales were earned, okay? That matches your revenues and expenses together. It also states expenses, really, the big takeaway is expenses must be recognized in the period in which they were incurred, okay? So in order to adhere to the matching principle, we use the allowance method. Because we say, oh, this whole year we've had this much accounts receivable, you know, sales and credit sales. Of that, we think this much is going to be bad debt. So it's an estimate but it makes sure we're matching our expenses to the revenues. Okay, so it's a very important principle. We also have the revenue recognition principle that kind of went along with that, where, that's why we do adjusting entries. So using the allowance method does require adjusting entries. So we will be doing estimates, okay? So we'll get into that in a little bit. Just wanted to kind of give you that background of why. Okay, but first we're going to look at the direct write-off method, and after we talk about the direct write-off method, we'll do an example in our practice together. That way we'll kind of understand what I'm talking about. So again, direct write-off method is not GAAP compliant, but if we're a small business with few receivables, we can look at DL Ross's account, and it says assume that $4,200 account receivable from DL Ross has been determined to be uncollectible. So DL Ross filed bankruptcy and we haven't collected from them in 90 days. That's my assumption here. Some of those indicating factors happened and we don't think we're going to collect. Under the direct write-off method, this is your journal entry. Okay, so we're going back to just the basics. We're going to debit bad debt expense, which is just a typical expense account. And we're going to credit accounts receivable DL Ross. So his specific or her specific account gets credited. So it gets cleared off. It's no longer a receivable, so it's no longer an asset to us. And we're expensing it to bad debt expense. Okay. So the write-off method's very straightforward, direct write-off method. Okay. Occasionally, maybe we have an in-house collections department, or maybe just DL Ross was having a bad time and now they came into some money and they want to clear off their account. So it does happen sometimes that we write off an account, or we sue them, and then sometimes that promotes them to want to pay. Whatever reason, DL Ross is now paying us. So what we have to do there for record keeping purposes is we reinstate their account and then we just clear it off as a usual entry payment. The reason we do that is we have to have record that we've reinstated the account. Because most of the time you just think, well, can't I just, debit cash and credit bad debt expense? Just kind of, oh, I received cash and I took it out the bad debt expense because now it's not an expense. But for record keeping, if we got audited, people would come in and say, well, where did that money come from? Like, you're just taking cash and, So with accounting, we have to show records. So what we do, if DL Ross then on November 21st, several months later, decided they were going to pay 6 months later, we debit their account to reinstate it. So we show, oh, DL Ross owes us $4,200, and we credit bad debt expense. So as you can see, that's just a reverse entry, right? It's the original entry we made to write it off, so we just reverse it to reinstate it, okay? And then we do a second entry where we receive the cash and then credit DL Ross's account. So that would be just a normal entry when we receive payment on an account. You debit cash, you credit accounts receivable. Okay, so with the direct write-off method, if that client then ends up paying, we reverse the entry and we receive the cash and credit their account. Okay. Any questions on that? It's pretty straightforward and easy. So the direct write-off method is pretty simple. And I think that's, yeah. So that's where I want to pause right now on the presentation. And if you will, go into Canvas, if you haven't already. And if you scroll down under Unit 1, you should see a link for Chapter 8 practice. So go ahead and open that Chapter 8 practice. And I'm going to load it in a new window. And I'm going to start it. Bless you. Okay, so our first example is actually using the direct write-off method. So we're going to cover that. It says, journalize the following transactions in the accounts of Canyon River Medical Company, a medical equipment company that uses the direct write-off method for accounting for uncollectible receivables. So again, this company is small, they're privately owned, so they can use the direct write-off method. So this first entry is actually a nice review from College Accounting Procedures, where we're actually just selling merchandise on account. So we're actually just going to, I didn't go over it in the PowerPoint, so let's see if y'all remember, right? Quiz. No quizzes, no! A quiz with no points. There's no punitive damage done by this quiz. You'll just get brownie points if you remember, right? So January 19th, we sold merchandise on account to Dr. Kyle Norby for $6,400. The cost of goods sold was $3,000. So does anyone remember when we sell merchandise on account, what do I debit and credit for that sale?
You debit accounts receivable.
Very good.
And you credit sales.
Perfect. Good job. And for how much?
$6,400.
Perfect. Very good. So accounts receivable for Dr. Kyle Norby is debited and sales is credited. So this is just a typical journal entry for a sale. A sale of merchandise on account. Okay, so sales is our revenue. Okay. It wants a second journal entry for the cost. It told us cost of goods sold was $3,000. Does anyone remember what I debit and credit for that second journal entry?
How much you made off the profit basically?
Close. We can calculate the profit, but we want to journalize the cost to us. Yeah, cost of goods sold. Very good. You're going to debit cost of goods sold and credit inventory. There you go. Yeah. See, you guys work together and you got this. You're a team already. Very good. So those are good journal entry reviews. But you're right. From there, is what we're going to do is we're going to debit these the cost of $3,000. Cost of goods sold gets debited $3,000. And inventory gets debited $3,000. So let's review that real quickly. I think everyone probably could use a refresher, right? So at least winter break is only a month and not the 3 months over the summer where everyone forgets everything. So good job for not, you guys remembered. Whenever we make a sale on account, we recognize the revenue first, and this was a sale on account, so accounts receivable was debited and sales was credited. We always have to do the second entry under our perpetual method of accounting. So this is saying cost of goods sold gets debited. Cost of goods sold is an expense account. So it's the cost of the merchandise. We bought it for $3,000 and we sold it for $6,400. Inventory is what type of account? Asset, liability, equity? Asset. Very good. Inventory is an asset. So when we purchased inventory, we debited asset, the asset account inventory. So when we sold inventory, it's moving out of inventory and we're expensing it out because it cost us money. So we paid $3,000 and sold it for $6,400. So that's when you could calculate like your gross profit from there. Because you take $6,400 minus $3,000, sales minus cost of goods sold equals gross profit. Okay. So we made a gross profit on that sale of $3,400. Okay. Just a little review because we'll get back into those concepts, as we go through the semester. So that's just a nice little review there of a sale on account. Okay. Then we move into the new step. So it says on June 2nd, we received $500 from Dr. Kyle Norby, and we wrote off the remainder that he owed us. So he owes us $6,400. Well, June 2nd, it took him, 5.5 months for him to pay us $500. He's like, here's $500, it's all I'm paying. Okay, well, we'll take his money. So this one's a little different than the example, right? Because we wrote off the full account. Well, if he's giving me cash, what do I do with cash? Do I debit or credit it? Debit, very good. So I'm gonna start with a debit to cash of $500. How much does he still owe me? Very good, $5,900. $6,400 minus the $500. So I want to write off that $5,900. So if I'm writing it off, what do I debit it to? Very good, bad debt expense. So I'm writing off to bad debt expense $5,900. What do I credit? Accounts receivable. Very good. And for how much?
64.
Yeah, the full amount, the $6,400. He paid 500, and then we wrote off the 59. So remember from college accounting, your total debits need to equal your total credits, right? So 500 plus 5,900 equals the credit of 6,400. Any questions on that? It's not too bad. Just getting back into accounting, right? Let's see, on October 23rd, we reinstated his account that had been written off, and he paid us the full $5,900 in cash. Sweet, right? So my first journal entry, and it kind of prompts me here, is to reinstate his account. So what do I debit and credit to reinstate that $5,900?
Accounts receivable and bad debt expense.
Very good. We debit accounts receivable, and we credit bad debt expense. So I'm just doing a reversal for just the $5,900. And then what do I debit and credit for the collection? Cash. Very good. He paid us cash. So cash gets debited, $5,900. And what gets credited?
Accounts receivable.
Perfect. Accounts receivable. Any questions on that one? Okay. So again, make sure you have in your notes that direct write-off method can only be used if they're a small privately held company. Okay. They're not GAAP compliant. They don't have to be GAAP compliant.
Are these for grades?
It's part of your attendance grade. So if you're here and you're participating, then you get your full credit. So if you don't even fully submit it, then it's okay. Good question though.
How come on accounts receivable on October 23rd, how come we have to make that entry at all?
Okay, so good question. So that's when I was saying, like, what we have to do in order for record keeping, we have to first reinstate his account so we know where that cash came from. Because if we just debited cash and credited bad debt expense, we wouldn't have any record of who paid us. So we do this reinstatement, so we put the money, like we show it going back into his accounts receivable, like we're billing him again, basically. And we're reversing it, we're taking it out of bad debt expense because it's no longer a bad debt expense because he paid. So that's your reinstatement. And then down here, you're just showing, I collected the cash. So we do these journal entries on the same day, but yeah, it has to be done.
So basically, we're just bringing back accounts receivable and getting rid of bad debt expense.
Exactly, yeah. You're reversing that.
Yeah, just to reinstate it.
Yeah. So yeah, this is just to reverse the fact that we wrote it off since he paid.
Mhm.
And then this is just a typical collection, like if anyone paid. Does that make sense? Kind of. Okay.